All right, I'm just going to go over some trends and what happened. So the market is going up here, and as the market comes up over here, this is where your selling is occurring. So you have some heavy volume selling, follow through. And of course, at the top, you have your climax. So you have climax followed by selling. But I want to see some confirmation. And that confirmation comes here. And at this point, the trend is established. There's no, you don't have to worry too much. Like the trend has been established. The lows have been taken out. You have internals are confirming the participation is on the downside. All right. And as you see, what happens is a lot of times people get fooled because they see just a higher high, but these higher highs, this is bullshit because it has no participation. When you have markets that are making higher highs and have no participation, it's suspect. So it's like empty air. It's just going up, but there's nothing to prove, nothing backing it. For when markets move up or down, they must have participation. And by markets, I mean indexes. You can't have an index going up and there's a lack of participation. So yeah, it made a higher high, but you must know the participation in that move. Because I think one of the key things, folks, I'll explain this. When you have trend and in any index, right, what's causing the index to make higher highs? Let me ask that question. What's causing is a very important word here, to make higher highs? It has to do with its factors, which are its components. So the market is a result. It is the result. The cause here are its components. The components going up are resulting in any index making higher highs and going up. So why this is important is because here on this leg up, people will definitely get confused because they'll say, oh, this is a spring. Oh, this and this is a base. Right? This is a base and this is your break. But what they fail to understand is the market is a result of its components, and you must have an understanding of what the components are doing. If you don't have an understanding of components, forget it. There's no logic to it. There's nothing. It's just empty air right here. So, I mean, I'll give you an example. On this move up, only 2 stocks went up. So the point here is that it's baseless. All right, and more importantly, what's it doing? It's actually counter trend testing. So you don't want to get caught buying a pullback in a counter trend that's all it's trying to do is test this breakdown. So that's what's really going on here. You had that breakdown, and all this thing is doing is counter trend, pulling back, testing the breakdown. How you know it's a breakdown? This is the low, this is the break, this is the increasing in volume, right? And that's it. This volume break is bigger than all the 4 subsequent bricks. So this move up was just a test. And as you know, when markets pull back to test, rally, or ice, one of the things you want to see is small participation. Say that again. When markets pull back to test creek and ice or support resistance or breakouts and breakdowns, it's very important that when they test, they have a lack of participation. meaning they have not a lot of stocks are going in that direction. Okay, so that's one way to filter out real moves versus just pullbacks that are meaningless, that are actually entry opportunities. So if you're looking for a pullback, you get a pullback, you get a reversal, you want to immediately see what is the market breadth, what is the participation on that pullback. If it's crap, that move is crap. So this pullback here, its participation is dying. There's nothing. So what do you think is going to happen? Because remember, market indexes are the result of its components. They're the effect. They're not the drivers. They're not driving the stocks. The stocks are driving the index. All right, so they're the result of of the components. So this is a very important relationship. So what do you want to know? You want to know how its components, how are they moving? And you see here, boom, this big move down is real. It's real. This here is real, and here it's fake. Right here, this is a spring. This is where it's fake. This attempt to go down, it's not substantiated by any heavy components making lower lows. So I mean, if the components are not making lower lows, and the market is making lower lows, and there's a very few components that are actually moving with it, it's going to reverse. Why? Because the components are the truth. Understand? The market will react according to the components. So you have to have this in mind. All right. Anyway, so market goes up, blah 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 blah, and then here, legit, why? There's some selling here. Why? The stocks themselves are moving down. You have to know the stocks are moving. You cannot trade or analyze S&P or Dow or whatever in isolation. At least I don't think, because that's the result, and you want to take a look at its causes, and the causes are its components. Those are the factors that drive the market. All right, the market is the result. Anyway, the point here is selling, 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 legit, and there's the buying right up there. What does that mean? That means participation is back in. Well, how do I know? Look at the mark numbers. It'll tell you the participation is back in. Goes up, more participation. So higher highs and lower lows must be validated by participation of the market's components. If you're looking at the S&P and you see a higher high, ask yourself, what stocks or how many of the S&P stocks are validating this up move? If you look at NASDAQ, ask how many of its components are validating this up move or its down move. So if you look at Dow, the same thing. Same thing. And you see that, that its components are validating it. And that's what happens. Here it's validated, here it's validated, and it's going to go up. Though now the only problem is like the pullback. You have to be ready for it. Okay, you have to be ready for the pullback, and see how many components are pulling back. It's very important to know that. If you don't know how many components are pulling back, then how do you know the pullback is a pullback and not going to just break through? Especially here, because a lot of folks will see some type of trend line break or wedge. I don't know what they'll see. Say, oh, look, you see, it's breaking the trend line, and this is a what is that thing called? Rising wedge. There's some type of wedge, and look, it broke. It's all bullshit. What you need to know is pressure and direction and components and all that. So I mean, over here, this is being validated. This is being validated. All right, so yeah. And that's all she wrote. So I'm also experimenting with this because there is a There are opportunities, like I said over here, for example, when it makes a lower low, right, and it pulls back, then reverses. The issue with this is that you have to know how to enter. If you just put your stop here, you're going to get stopped out. So you have to know how to enter. You know, you can wait for the reversal. That'll do it. Then enter. You know, that's one way of doing it. There's a lot of ways of doing it, but I mean, you're not going to get a low risk entry. It's going to cost you probably a brick plus the wick, almost 2 brick bodies. But you know that this is legit, and it is. It goes down until you see these lower lows not being validated. Like this one here is not validated, and this whole shit up here is also not validated. And then what happens? Validation. You know. So this is just one approach. As you know, in Wyckoff, there's a lot to learn. But one way, I'll go through it. So one way is component. And let me take a step back. So the idea here is, let's say you're a pullback trader. All right, you're a pullback trader. You get in on pullbacks, and so what's important? What's important are the rallies. If you're pulling back, if you buy pullback or sell pullbacks, you have to know rallies. So on rallies, you have to understand certain things. One is component participation. All right, this is very, 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 very important. 2, obviously volume. Why? Because the natural, volume, what it does, it validates the price action. Why? Because rally volume is greater than the pullback volume. Simple as that. Whichever direction, and this is almost all, this is pretty much the case. Just like the pullback has less volume than the rally, it also has less distance than the rally, and they're validating each other. So here you have a case where that is just not true. Here, there's too much volume here. All right. So I'm not saying that this is more volume than the rally, but this is just way too much volume. And then when it breaks like that, that means that the sellers won and the buyers could not absorb that pressure to go higher, and they just broke. So going back to it, the component participation is very important. The volume is very important. And let's see what else. I mean, those 2 are just the basics. So, and those are the core things, right? And also, it shouldn't have a shorting of the thrust. If you have rallies, they need to have follow through. It cannot be like, it can't be a weak rally, meaning you should not have this. That is, and I'm just looking at it from a thrust to thrust. That is like a probe, all right? That's like a probe to go higher, but I'm not, and it needs to be clean, green, 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 green. So you want clear rally, which is with good thrust. See from high to high the amount of distance? See the high? What does that mean? That means demand is still there. And when and it's really important to watch these turning points, because they represent overhead resistance. So at these turning points, the amount of volume that came to cause the rotation down is important. This one here from the low, from the support point, amount of pressure here is very important. And the breakout level over here is really important, because those areas are where demand overtook supply. So there's trap supply there. And then when it gets tested, it's going to bounce. If not by new buyers, it's going to bounce because of the short covering, and that's enough. That's enough for you to get a move on a lower time frame. So this was interesting over here, where your market go down here. The thrust is shortening, right? It's shortening, then 1, 2, 3, and then rally. This is quite nice. Right? Now, do you know here that this is going to fly? You don't. And you know what? It's all right. You can wait. You know, you might not catch it here. You might not catch it there. You might catch it here. You know, against this little minor spring. You might catch it there. You know, and then be done with it. So because over here it didn't pull back enough, so you're not going to get it, and you have to be okay with that. All right, because in strong demand, when you have strong demand, market's not going to pull back. It's just not. It's going to have you know, the lesson of halfway back is that it's a relative strength. It's a relative strength thing, right? So if you're measuring demand and supply, and that 50% is the typical amount. 50% is the typical amount of a pullback. Okay, so in analyzing pullbacks, that 50% is a typical amount. If it retraces less than that, that means that supply is weak. If it retraces more than that, that means supply is getting stronger. So if it retraces 70%, that means supply is getting stronger. All right. If it retraces only 30%, that means supply is weak and it's going to go up. It has a tendency to go up. So this you see all the time. Like you know, over here you have this rally. Look at this, one brick back. Obviously supply is weak. What does that mean? Demand flies. Then what happens? It has two. So it is supply is getting a little bit stronger, but it's still weak. Then it flies because supply is weak, demand is going to fly. Then over here, this is a problem because supply is now getting stronger, and this is the biggest down wave in 10 waves, and I'm sure the volume has increased. So this is the problem, and it touches all the way back to support. Now we have a problem, and you can very, very, very clearly see that now when supply is strong like that, it takes a lot of pressure from demand to break the high, because it has to retrace back up a lot more and then break out and make a higher high. So because of those factors, so demand will naturally get more exhausted. Here you only have one brick back, demand can fly up. Here you have two bricks back, demand can go and make a nice higher high. Here there's a big pullback, so demand has to spend all that energy going back up to the high, then break it, then make the higher high. So it's spending a lot of that demand pressure just getting back to even here at the prior high, and then spending the rest of the demand to break out, and then spending even more demand to make a higher high. So it's getting exhausted. That's why the shortening of the thrust is very important. You can very clearly see. Look at the thrust here. I'm going to draw it how it's supposed to be done. Right? So from here, measure the thrust from here to here. Look at this thrust. That's a lot of thrust, right? That's good. Look at this thrust. That's a lot of thrust, right? That's good. That's good. But now look at the thrust. Look at the distance. Look at the distance. See? From here to the next high, look at all this thrust. From this high to the next high, look at all this thrust. Now, look at from high to high. What happens? The thrust is diminishing. That's the shortening of thrust. Get ready for the reversal. Boom. And you will see this. You see this all the time. See, I'll give you another example here to here. This low to this low. And then from that low to that low is only 2 bricks. The thrust shortens. Right? Here it's still basing and all that, and now you have that rally. You have good thrust. One way to measure it, you just draw a line. Right? 1. Good thrust, good thrust. Good thrust, excellent thrust. What this is. You can see the distance between the line measures the thrust. And here, I think we have a problem. I'm not really sure about this, but from here to here, you see how the thrust again is small? Now tell me, look at this, demand strong, demand strength, demand strength. Here we got a problem. So chances are it's going to pull back. That's how you can use shortening of thrust, and I can show you again and again and again. Here, thrust, here, thrust, now. What happened? This is the problem. So obviously it's going to rally. And so usually what happens is when you're examining trends, they turn in 2 ways. One is that shortening of the thrust, and the other is climax. So for example here, this is not a shortening of thrust. I mean, some might say the thrust is shortened, but I wouldn't consider it a shortening of thrust. I consider this right here, from here to here, with that heavy price volume, to terminate using a climax. And that climax got validated by the heavy selling here and the heavy selling there. I'll give you more examples here too. So always the case. You go boom, right there. Right, and also note when you look for shortening of thrust, you want to see what happens after it. Right, it needs to be a heavy selling. There should be a change of behavior after it. This I cannot really read because it's all shit in the middle. But here, you'll see here again. You just draw a line. Right? 1, think this is, right there. It's very, very clear. Look at the distance from here to here to here to here to here. It shortens, and not only does it shorten, but there's a reversal right after that. I mean, obviously it's going to rally. Now, I'm not saying it's going to continue to trend, but what I am saying is it's difficulty to go down, and when you have difficulty to go down, it's going to reverse. And that's what it does. Because of the shortening of the thrust, followed by that, it gives one rally, nothing special. You know, after that, it runs into some problems. And also, this only works in trend. It will not work in anything else. In sideways market won't work. See over here, 1, 2, look at the highs, 3, here the thrust does shorten, so right about there. See, look, the gaps are between high to high is shortening. See, look at those two, and now look at these. It's a no-brainer that it's getting shortened. It's very obvious. Look, high to high to high. The thrust is shortening. And then eventually there's the change of behavior that breaks. Right? So you even see it here, right? The only time, if there's no shortening of thrust, look, what else you look for? You look for climax. And this is again another example I can very clearly show you. Here, you just draw your line. You don't have to be perfect. It's not a perfect trend line, right? And you see here, you see this is very small, right? Then you get good thrust. First, it has to have good thrust, that, you know, and then it has to shorten. See that? Now, right there, there's still some thrust there, but here it's a no-brainer. It shortens. Right there, and the selling, and then what happens? Tap, breakdown. And as I explained, it's usually that way, or the other way is boom, climax, and goes the other way. All right, so that's just a lesson on how to analyze trends and looking for reversals. There's other ways to do shortening of the thrust, but this method that I've shown here, this is directly from Wyckoff. He used in the Wyckoff course. So some people, what they'll do is they'll use trend lines to see shortening of the thrust, meaning they'll do something like this, and then they'll duplicate it, and they'll see, oh, it's away from the trend line, right? So that's one way to do it. But the method I showed here, looking at the high to high, the space between the lines that represent from one high to the next, what I showed here, which is, again, just draw a freaking line. It could be a straight, it could be like that, and then just start marking the highs. So, and I'm going to give a little bit more, like when you analyze trend, there's at least 3 techniques. One is what I'm showing here, measuring thrust, which is looking for shortening of thrust. The second is your halfway backs, right? When those selling waves get really strong, it will eventually identify a change in behavior. So what do we call that? Just looking for the pullback retracement will tell you if the selling pressure is increasing. And the third is the obvious, everybody knows, but they not really, is the trend line break, right? So those 3 things together is the way you analyze trend. The thrust, the pullbacks, and the trend breaks. Besides that, like I explained, the trends have a tendency to end on shortening of the thrust or climaxes. Once they do that, you want to see confirmation in terms of a change of behavior afterwards. And then change of behavior will be confirmed by that LPS or LPSY, also known as a lack of demand or lack of supply. Okay? All right, folks, that's all. Take care. Bye.